Hello. In this video, we're going to be talking about how to account for a long-term notes receivable. We had a previous video where we went through short-term notes receivable. A long-term notes receivable is almost the same as a short-term notes receivable, except that the payment period is longer than 1 year. So if you recall, a notes receivable is when a company lends money to either their customers or their employees or to someone else in exchange for interest that they will receive on that note. And then the entity that they lent the money to has to pay back the company the note at the end of the term. So we're going to go through this example, which is similar to the short-term notes receivable example with one slight difference. On the Stridewell Wholesale Shoe Company manufactures athletic shoes that it sells to retailers. On January 1, the company sold shoes to Harmon Sporting Goods Stridewell agreed to accept a $700,000 two-year note in payment for the shoes. Assume a 12% effective interest rate. Okay. So we're going to go through it on January 1st. And now the big difference with the long-term notes means greater than 1 year. The terms of the note are greater than 1 year, at which point you have to take the time value of money. Okay, you have to take the time value of money into account when you have a receivable or a payable, whether you borrow money or lent money. You have to take the time value of money into account when it's longer than a year. So on January 1st, Stridewell would have a notes receivable for $700,000 because the Harmon Sporting Goods will owe them $700,000, right? So because this is a two-year note, we cannot just book sales revenue for $700,000. What we have to do is we have to find the present value of the $700,000 using the present value table. And this is going to be the present value of $1, where our number of periods n equals 2 because we have two, it's a 2-year period, and the interest rate equals 12%, and we're told that. So your sales revenue is going to be your $700,000 times 0.797194. That's directly from the present value of a dollar table, and that gives you $558,000. The difference is going to be this discount on notes receivable, this 141, which is really it's really going to be interest revenue over the course of the loan of the receivable. And we'll go through that. So a year later, right, on December 31, we have to record interest revenue. And we're told the interest revenue is 12%. So what we do is we are going to look at the net carrying value of the note receivable, which we'll go through, and multiply by 12%. And that's going to be your interest revenue, and then you're going to debit your discount on notes revenue. I should also tell you that when we have on our balance sheet, we have a notes receivable. The discount on notes receivable is a contra asset account. So when you present the balance of the notes receivable on the face of the financial statement or in the notes, you're going to have the principal amount, the $700,000, minus the discount. Just a little side note. But I want to go to a table which I think better explains or shows how the interest component is calculated. So we're going to start with our beginning balance, which was the $700,000 present valued by 2 years at 12%. You can take your interest rate of 12%, and then your interest revenue is really just your beginning, your net book carrying value of your receivable, which is going to be the $558,000. And we're going to look at the 12% interest rate that we have. And we're going to, let me just do this if I can. Okay, I guess I can't. And multiply the 558,036 times the 12%. And that's your interest revenue of 66,964. And so what happens to your notes receivable, if you look at your notes receivable balance, what we're gonna well, it's the discount, but your notes receivable balance increases by the discount because now you've amortized 66,000. So now our ending balances of the net book value of the notes receivable is 625,000, and we carry the last prior year ending balance is the current year beginning balance. So in year 2, we're going to take the 625,000, multiply that by 12%, and year 2, this is going to be your interest revenue in year 2. So the interest revenue on long-term notes receivables, the interest revenues are not consistent, are not the same from year to year, because you're always multiplying it by the net book carrying value of the receivable. So in this case, year 2, our interest revenue will be 75,000, and we'll discount the amortization by 75,000, and then our ending receivable will be this full 700,000. So if you kind of look at the notes receivable, if you look at it through a T count, we start at 558,036, right, on 1/1/27, and then we amortize back 66,964 at 12/31, and then we amortize back 75,000 on 12/31/2028. And so then at the end of it, we have the full $700,000 note receivable on our books. So that way, when we get paid the $700,000, we have a balance of $700,000 at the end of 2028 that we can credit, and then we should be receiving the cash for $700,000. So that's just how that works. I wanted to quickly kind of show you, but we'll go through the entries here. Let's go back to the slideshow. Okay. So again, 1/1/27, I issued a notes receivable. I present value that for $1, right? Present value of $1, N equals 2, I equals 12%. And then the difference is this discount that I'm going to amortize back as interest revenue for each year. And so in 12/31, I take my 558 at 12% equals 66,000. So I credit interest revenue and I debit my discount on notes receivable. And then at the end of the following year, I have to take my new net book value, is that going to be the 558 plus the previous interest revenue, which is right here, which gives me, I think it was 625,000 times the 12% is 75,000. So at that point, I can record interest revenue for 75,000. I amortize the discount on the notes receivable by debiting it by 75,000. And then, like I showed in the Excel file, my notes receivable balance will be $700,000, so that I can credit $700,000 and I can debit cash. Now you might say, wait, my notes receivable was $700,000 when I recorded it on 1/1/27, right? It was $700,000, but you have to remember that when this and this go together. This is the discount is a contra account to the note receivable. So when you're calculating your net balance in your notes receivable account, it's going to be the 700 minus 151. That's what you start with. And so we build it back up so that the net book value is actually 700,000, and that's the amount that you can credit at the end when you receive the $700,000 of cash. Another scenario for long-term notes has to do with notes received solely for cash. So if a note has unrealistic interest rate, whether it's too high or too low, doesn't matter if it's interest bearing or a non-interest bearing note receivable. If it's if we issue a note receivable and we give out cash, then the cash paid to the issuer, to the person who we're lending it to, is considered to be the note's present value. So you don't have to do the present value of $700,000 if what I gave out is actually cash. So note in the previous example, I didn't actually give out cash for that receivable. I sold shoes to the Harmon Sporting Company, and in exchange for them paying me, I agreed for notes receivable. So that's not a note receivable that I issued for cash, and therefore we're going to do, we need to calculate the present value of that note. When it's for cash, there is no present value because the cash given is assumed to be the present value of the 700,000. And just like with accounts receivable, a notes receivable has to be evaluated to see if it's going to be collectible. And so if a company anticipates a bad debt on short-term notes receivable or long-term notes receivable, it uses a similar allowance account, similar to the allowance for doubtful accounts for accounts receivable. They will use an allowance for credit losses for the notes receivable, and they can estimate that allowance. There's various ways to estimate that. And so they have to report that on the face of the financial. They have to put the face value of the principal value of the note receivable minus allowances for credit losses to show the net. And this is what they believe, the company believes, that they will be able to collect at the end of the term of the note.